After redlining, the urban reinvestment movement in the era of financial deregulation. By Rebecca K. Marchiel. Published by the University of Chicago Press. Introduction. Neighborhoods first. In early 1975, Chicago community organizer Gail Cincotta announced a damning report on her city's financial institutions. She and other activists had spent the past 3 years accusing these firms of redlining, refusing to make loans in aging, integrated, and majority-minority neighborhoods. Bankers, for their part, had spent the past 3 years denying the accusations. But in 1975, for the first time, activists had evidence to support their claims. A new federal law gave them access to financial institutions' records, which they analyzed to reveal where the institutions issued loans compared to where their offices were located. The patterns were striking. Local banks collected savings from the city's older, racially changing neighborhoods, but rarely lent money there. On the west side, one financial institution collected over $10 million in deposits from customers but made 0 mortgage loans in return. Of the 41 Chicago banks examined, 39 lent less than 0.1% of their combined $42 billion in assets to redlined neighborhoods over the course of an entire year. In contrast, these institutions lent plenty of mortgage money in the suburbs and in wealthier neighborhoods. What was happening, the activists argued, was that the banks serve as one-way conduits for the deposits from the city neighborhoods, taking them in and depositing them along the lakeshore or in the suburbs. By 1983, however, the relationship between these activists and their banks looked quite different. That fall, First National Bank of Chicago proudly announced its plan to commit $100 million in home and small business loans for the neighborhoods that activists had identified as redlined 8 years earlier. And community groups would play a large role in implementing the program. Neighborhood representatives helped distribute those loans to underserved areas. They screened applicants and identified promising urban redevelopment projects. Cincotta and other activists joined local bankers on review boards that assessed borrowers' creditworthiness and discussed changes to improve the program. Over the next months, 2 other Chicago banks followed First National's lead by allocating $173 million for housing, commercial, and industrial development in inner-city Chicago neighborhoods. "Our communities have been written off up to this point," said one activist.
Sample complete. Ready to continue?